Okay, let's recall what we learned last week for this topic. Oh, just now I didn't notice the mic was turned off. Okay, just now I said I was sending reminder to the students who are not here yet. Okay, so let's have a look. Page 298, page 298. Okay, recall what we learned last week. Last week, we were talking about companies, right? The concept of company, see it as a slice of pizza. Every slice is one share. Every slice is one share. And when will company issue a shares? When they need money. When they're starting expanding their business or when they need money, okay, then they have to raise money by selling shares. And every share has a price, and shareholders have this benefit limited liabilities. Okay, meaning if they have spent 1,000 to buy the shares, then 1,000 would be the maximum loss, right? And then we talk about two types of shares, ordinary shares and preference shares. And we talk about when you buy ordinary share, you become ordinary shareholder. When you buy preference share, you become preference shareholder, right? These are what we went through last week. And we also talk about the dividends. Dividends received by ordinary shareholders are variable. And for preference shareholders, dividends gotten by them is fixed. Okay, they receive fixed dividends. And then we talk about voting rights. We talk about voting rights in detail. It's about selecting the people to assume the role of directors to run the company. Okay, and it is ordinary shareholders who would care about who will become the directors of the company, because ordinary shareholders' dividends depends on how good the company has been run. Okay, because it's variable. Their dividends are variable. If the company has done well in a year, then ordinary shareholders would receive higher dividends. Okay, and the other way around means lower dividend. But preference shareholders don't care. Preference shareholders would still get fixed dividends every year. Okay, and now today we continue on to the next point between these two types of shares. Let's do some annotation here. I use a highlighter of another color. This time I'm going to highlight the next point that are linked to one another. I use green. Okay, highlight this. If you have highlighters of different colors, you can do the same. Okay, then the related point, okay, highlight this. If you don't have highlighters, you use symbols, okay, you use symbols. Let's say star, okay, star here, star there, okay. Okay, so this is about the priority in receiving the dividends, the sequence, kind of like the priority in getting the vaccination, okay, for the COVID, okay, vaccination for the COVID, where the senior citizens gets to have the vaccine first, right? Then followed by the lower group, the younger group of people, right? And here is between ordinary shareholders and preference shareholders. Both groups of shareholders receive dividends, right? And when it comes to the priority, preference shareholders would get first. Preference shareholders would receive first. So you see this line. Ordinary shareholders would only receive dividends after preference shareholders have received theirs. So it's a disadvantage to ordinary shareholders. Imagine that if there is no more profit for the year to be distributed. Okay, dividends, you see it as distribution of profit. Okay, distribution of profit. Let's say preference shareholders have received their dividends and the profit for the year has gone to a very low level. And in that case, ordinary shareholders would likely receive no or very low dividends. Okay, you get the idea? Let me repeat. Preference shareholders would receive their dividends first. Okay, let's say all the preference shareholders have received their dividends and left with just a bit of profit for the year. Then ordinary shareholders would likely receive low dividends. Okay, so it's a disadvantage to ordinary shareholders. Now let's look at another related point, which is an advantage under the preference share column. So you see, it says preference shareholders receive dividends out of profit for the year prior to ordinary shareholders do. Prior to means before. Prior to means before. So yeah, the same point that I mentioned, but it is an advantage to preference shareholder. Okay, even though it's a disadvantage to ordinary shareholder. Okay, next we look at another point. Here you can remove this. I don't need this paragraph anymore. Not necessary to have. And the same goes to this. This one you can remove, not necessary. Okay, let's look at the next point. I'm going to use the different color highlighters to highlight the next point. I use dark blue. So if you have the same highlighter, you can do so. Okay, now let's talk about the next aspect between the two types of shares. You look at this term, winding up. Can see? Winding up. Okay, what is meant by winding up? It means the same as closing down. It means the same as closing down. You saw this term on the previous page. You saw this term on the previous page. Somewhere here. Liquidation means the same as closing down, means the same as winding up. These three terms mean the same thing. These three terms mean the same thing. Okay, closing down, winding up, and liquidation. Now, what are we going to discuss here? You draw a flow chart together with me using some area under this table. Okay, so you write down when company closes down, okay, so when you have closed down your company, it means that you are closing down your business. Whatever you still have in the business, do you still need them? No, right? Let's say you have a factory. Do you still need that factory? No. All the things that are in the factory, do you still need them? No. So you have to sell them off. So when you want to close down your company, you will sell off all assets. You will sell off all assets. And you turn them into cash and bank. You turn them into cash and bank. Okay, because once you have sold off all other assets, what you still have would be cash and bank. Okay, and once you are done with all the selling of whatever you have in the business, what you would do, you would distribute the money back to the owners, as well as settling all the liabilities. Okay, liabilities are the debts you owe to other people. Okay, so who would get the money first? Creditors are liabilities. Okay, creditors are liabilities. Creditors would get back their money first, or the shareholders. It is creditors first. So you write liabilities brackets. Okay, you have to know that liabilities means creditors, people whom we owe money to them. Okay, we always owe money to the creditors. So liabilities get settled. Okay, once you have gotten a lot of money, you have to settle all the liabilities. Settle means you pay off. Okay, pay off all the liabilities. And then only owners would get back their money. Okay, shareholders are the owners in companies, remember? So there are two groups of shareholders. Which group of shareholders would get back their money first? It is preference shareholders. So you write preference shareholders would get back their investment. Get back their investment means they get back the money that they invested into the company. Followed by ordinary shareholders getting back their investment. So this is the sequence of events. This is the series of events that would happen when the company closes down. And it's very important. Later, I show you some questions that are linked to this, and you would know how important it is to know this entire table. Okay, this entire table is super important to solve many of the theory questions. Okay, so let me repeat. When the company closes down, when the company closes down, they sell off all their assets, and then they get back everything in the form of money, and then it starts with creditors getting back their money first. Okay, we settle those liabilities, and then followed by preference shareholders getting back their money, their investment, then only followed by ordinary shareholders getting back their money. Okay, so this priority you must remember. Now let's read the paragraph in blue. Okay, make sure you have written this diagram down. Okay, the flow chart. So have a look at this, the one in dark blue. When company closes down, shareholders, okay, the word shareholder is under ordinary share column, right? So I'm referring to ordinary shareholders here when you see the word shareholder, are only entitled to claiming back their invested capital after the preference shareholder, PSC is preference shareholder, would have made their claim first. Okay, therefore is a disadvantage to the ordinary shareholder. What if there's no money left after preference shareholders have gotten back their money back? Then ordinary shareholders would have lost their money. They would lose their money. So it's a risky investment to be an ordinary shareholder. Preference shareholders, you read this paragraph, is an advantage to preference shareholders though. Capital is repaid to the shareholders. So here is referring to preference shareholder. Before ordinary shareholders, you remove this replace it with shareholders. Okay. Before ordinary shareholders in a winding up. Okay. Winding up means company closing down. Means the same as liquidation, closing down, winding up. These three terms mean the same thing. Winding up, liquidation, closing down. These three mean the same thing. Okay. So importantly, remember what would happen after the company has closed down. Okay. And the priority in getting back their money, you also have to remember. Okay, liabilities followed by preference shareholders, then ordinary shareholders. Let's see some questions. Okay, so let's see some questions where you can apply this table. Okay, the things that you have learned in this table. You go to, okay, let's go to a page at the back. Okay, come to page number 308. We answer a question together. Okay, page 308. Question F. Okay, page 308, question F. Okay, so is this a past exam question? Yes. It came out in 2016, May, June, 5 to 7 years ago. 5, right? Yeah, 5 to 7 years ago. And would it come out again? Later you would know. Okay, later you would know how popular such question is. So let's read this together and then answer together. State two ways in which the ordinary shareholders may be affected. If NECO Limited, whenever you see the word limited, it indicates that it's a company. Okay, it's a company. Raise the additional funds means getting money. Okay, by the issuing of preference share. Issue means sell. Okay, sell preference share. So is comparing between ordinary shareholder and preference shareholder. They ask you, if the company issue preference shares, what would happen to the ordinary shareholders? What would happen to the ordinary shareholders if the company issue preference shares? It's about the priority. First priority is about when the company closing down. Another priority is about the distribution of profit for the year as dividend. Okay, follow me and write together. For the first few attempts you are writing this, it could be challenging, but you must learn how to write this. Okay, so for now, write together with me, but eventually you have to know how to write yourself for this. And it's very popular in the exam. You write in the event of company closure, okay. In fact, if I have more space, I would like to write there'll be preference shareholders around who would make the claim first. Okay. When the company closes down, preference shareholders would get back their money first. Okay. And if there's no money left, ordinary shareholders would make losses. Okay, they would have losses. Okay, now the other thing is about dividend. Okay. Okay. Done. Okay. So when you're done with writing, please let me know with the word done. If you have question to ask, then you can ask. Then we move on to the question, move on to the next question together. Okay, I wait for you. Okay, good, Celine. Okay, I wait for Zanning. Wait for Zanning. Then we move on to the next one. Okay, good. I know some of you could be going for the exam in October, November 2022, but there's no harm learning the topic earlier. Okay, so let's move on to the next one. Hold on, yeah. Let me see which one is suitable. Okay, page 324. Page 324. Page 324. We are now looking at question B of page 324. State two ways in which the existing ordinary shareholders may be affected if an issue of preference shares is made. Is this the same question as the one we did just now together? Yes, it's the same question. Okay, and again, it's the 2-mark question. It's the same answer. Okay, so just copy and paste yourself. And why am I bringing you to here? Because it's to show you how popular this question is in the actual exam. And it came out in 2018, October, November, 3 to 4 years ago. Okay, 3 to 4 years ago. So it's quite close, okay? It could come out again in the future, really, okay? So just to show you how popular this question is, and you must learn how to write those answers I showed you just now. Okay, next page, you look at question C, page 325. This is different. Let's answer this together. Okay, it's between the old ordinary shareholders and the new ordinary shareholders. So let's read this together. State two ways in which the existing ordinary shareholders may be affected if an issue of additional shares, state two ways in which the existing ordinary shareholders may be affected if an issue of additional ordinary shares is made. That means the company right now already has some shares issued to the investor. Okay, right now the company already have some ordinary shares issued to the investor, and the company is looking for more money. The company is looking to raise more money. That's why the company is considering to issue more ordinary shares. Issue means sell, okay? Issue means sell. So what would happen to the old ordinary shareholders? Okay, and you have to recall one term known as dilution of ownership. I show you. Dilution of ownership means that when the company issue more shares, okay, if the company issue more shares, but you are still holding the same number of shares, let's say before and after the company issue more shares, you still hold just one slice of the pizza, you would experience dilution of ownership. You would have less power in the company. You have lower ownership level in the company. Okay, so this is one of the effects. Okay, let's write down the answer. 325, right? Okay, so let's write. First one, you write what I mentioned just now, dilution of ownership. The existing that's it. Don't have to explain further. Don't have to explain further. And why don't you have to explain? Because of the word state. State means tell. Okay, just tell. And furthermore, it's a 2-mark question indicating 1 mark for 1 point. Okay, no mark for explanation. So don't have the right explanation. And then let's write one more point. We can talk about the dividends. Okay, imagine that there are many ordinary shareholders, and they would have to share the dividends when the company has made money, right? So you write down together with me for the second point. Okay, once you are done, let me know with the word done again. Then we see the next question. Okay, don't just blindly copy. You must also understand all the sentences here. Okay, good, Celine and Zani. I wait for the rest. Okay, I wait for Amelia and Chen Chen. Okay, good. I wait for Amelia. Dilute. Yes, correct. It doesn't mean the chemistry term dilute, okay? But here it means becomes lower, smaller, or decrease. Correct. Okay, yeah, now we see the next one. Have to be patient, yeah, okay, with this topic. This topic has a lot of theory. And yeah, it's the only topic with a lot of theory. You come to page number 332. Come to page number 332. 332, question D. Suggest two disadvantages to the existing ordinary shareholders if the funds are raised by issuing additional ordinary shares. It is between the new ordinary shareholders and the old ordinary shareholders. Existing means old. Is this the same question as the one you did just now? Yes. Just copy and paste on your own. Okay, just copy and paste on your own. Is a question coming out in 2018. So not too far ago as well. Okay. So I bring you to here just to let you see how popular it is. Okay, so just copy and paste on your own. Same kind of question. Okay, then we see the next thing. Page number 33. Sorry, not here. Next one. Here, page number 338. Page number 338. Okay, two features of preference shares. But I think we did this question last week. Okay, but let's do it. It's very simple anyway. Okay, page 338. Let's write the answers together. It's just to recall what you wrote last week. You can talk about voting rights. You can talk about the dividends. So you write that's it. Okay. So these 2 points are very easy to write. Okay. Receive fixed dividends. Okay. Preferential holders receive fixed dividends. They have no voting rights. So this is also a very popular question in the exam. And yeah, you have to watch out. You have to watch out. We see the next thing. Okay, next page. Sorry, not next page. 344. 344. Okay, 344. Question D. See, is this the same question? Yes. Page 344. Same question. D. Okay, coming out in 2019. 2019. May June. Three features of preference shares. So is it possible for such question to come out again in the future? Yes. But this time they ask for more. They ask for more, right? So the first 2 points you write yourself. Okay, just copy and paste from the previous question. Okay, just copy and paste yourself. Firstly, talk about the fixed dividends, the fixed dividend. Secondly, talk about the no voting rights. Okay, no voting rights. Okay, number 3, you can talk about the priority in getting dividends. So you're right. Prior to means before. Okay, prior to means before. Before. Okay. 3 features. Features means characteristics. Okay, characteristics. Okay, once again you are done, then you let me know that. Okay, then we see the next question. Very soon we are getting back to the notes. First two you copy on your own at home. Yeah, the first two are easy to write. Okay, I wait for few more confirmation. Okay. Okay, good. Now let's see the next question. We are almost to the end of this handout. Yeah, we are almost near the end of the handout. Okay, this one we do later. Now get back to the notes. Get back to the notes. We learn the next thing. You get back to the notes. Page number 301. Page 301. Okay, page 301. First half of the page. Okay, upper half of the page. Page 301. Okay, so have a look at this and fill up the blanks together with me. There are 4 blanks here. You write here authorize. You write here issue. You write here call up. Then you write here pay up. Okay. Everything you see here is not very important in real life, and in the exam is also not very important. It is only important for the definitions. Only the definitions are important. I'm not sure if your definitions looks like mine or not, because recently, a few months ago, I edited the definition. And I think this is something you don't have. Process of selling shares to the investor. Okay, if you don't have, then you copy it down or you use your phone, you take a picture of it. Okay, take a picture of this entire thing. Okay, and now let's start with me explaining. Okay, what are all these 4 terms? Before I explain, you look at this first. The entire process of selling shares to the investor. Okay, first thing that would happen is the investor must order the shares first. Order means place an order. Okay, kind of like you go to the Grab app and then you place an order for food. Okay, so place an order. Okay, order the shares first. After that, don't have to pay first. Okay, investors don't have to pay first. They get the shares first. They get what they want first. Okay, kind of like you buy food, but when you buy food, you have to pay first, right? But here you get the food first. Okay, so here you get the shares first. You order and then get the shares. Then they will ask you for payment. They will ask you for payment. Okay, company will ask for payment. Okay, you write here, company asks for payment. Then only payment would be received from the investor. Okay, this is the sequence. And if you remember this sequence, if you can memorize this sequence, then you will understand what these 4 terms mean. Yeah, so place an order, then get shares, then you will be asked to pay, then you make payment. We look at the first term, authorized share capital. Authorized share capital means the maximum number of shares, you read this, maximum number of shares that the company can issue. Maximum number of shares that the company can issue. Okay, that means the company can never issue shares more than the number of authorized share capital. Okay, and it is 500,000 shares. And what is the maximum number of authorized share capital? I'm not sure. Okay, this is something outside our scope of learning. So for our accounting subject purpose, you just have to know the definition. How they came out with authorized share capital, who set this rule, we don't have to know. I don't even know. Okay, if you want to know, then you can do some searching online. But for this subject purpose, just have to know the definition. Okay, maximum number of shares that the company can issue. That means, let's say this is the authorized share capital in a company. That means that company can never sell more than 500,000 number of shares to investor. Yeah, so this is the meaning, authorized share capital. With this said, of course, the company cannot issue more than 500,000. Therefore, issue share capital must be lower than or equal to. Agree? Okay, it must be lower than or equal to authorized share capital, because just now I said maximum number of shares that can be issued is 500,000. So of course, issue share capital must be lower than or equal to. Okay, so you can also draw the sign here, lower than or equal to. Okay, so issue share capital, as the term implies, it refers to number of shares that have been distributed to the investor, number of shares that have been given, okay, given to the investor. Okay, but not yet paid, yeah, not paid yet, okay, not paid for yet, but it has been given. Okay, so let's say 400,000 number of shares, just example, 400,000 number of shares. Then followed by the next term, call up share capital. Call up share capital means, okay, read the definition. This portion of shares have been asked to make payment. Okay, people who have bought this portion of shares, the company have called them up to make payment. So we read this portion of issue shares which payments have been requested for. Okay, so logically it should be lower than or equal to issue share capital as well. Okay, call up share capital must be lower than or equal to issue share capital because of this thing that you have seen just now. Okay, the process of selling shares must place order first, then get the shares, and then the company will ask you for payment. Right? You get it? Because it cannot be greater. Okay, call up share capital cannot be greater than issue share capital because only the issue share capital would be asked to make payment. Okay, you cannot request for more payments than the number of shares that you have issued. Okay, therefore you have that sign here, lower than or equal to. Okay, lower than or equal to issue share capital. Lastly, last term, pay up share capital. This is the portion of shares which have been paid by the investor. Therefore, logically, it should be lower than or equal to call up share capital as well. Let's say call up share capital is 350,000 number of shares. This is the portion of share which you have asked the investor to make payment for. And logically, pay up share capital must be lower. Okay, you cannot collect more money than what you have requested for, right? Therefore, you have this sign here. Okay, it could sound confusing, but yeah, that's the logic behind it. Okay, so first and foremost, you must know these processes. Okay, get this process into your mind first. Order, get shares, ask for payment, then payment received from the investor. So you read this, let's read this together. Pay up share capital, portion of shares, payments have been requested for, and they have been fully paid as well. Okay, and this is just an example of the number of shares. Okay, must be equal to or less than. These four terms, if you don't want to know them in detail, just have to know the definition. Okay, the list that you have to know is that definition. Just remember that definition. I show you a question asking you for definitions for these few terms. Okay, let's go to a question. I have to find the page though. I cannot remember where is it. Okay, higher. I have to scroll it higher. Somewhere here. Here, page number 323. Page number 323. Page number 323. 323, yeah. Question B. See, this is exactly what I said. They would ask you for the definition. State the meaning of each of the following terms, but it is just 3 terms out of the 4. Okay, but I think more than enough to kill many students because many students cannot remember or be aware of the existence of these few terms. Issue share capital, co-op share capital, pay up share capital, must know the definition. This question came out in 2016, October, November exam. Okay, so you write yourself at home, okay, when you are free. Okay, just write yourself at home when you are free. Copy and paste from the notes. Get back to the notes again. Get back to the notes again. Now you look at page number 301. Come back to this page 301. We look at the second half of the page. Here it is between number of shares and value of shares. Value means worth, right? Okay, value means worth, value. That means you must have the dollar sign. Here is about knowing how to do the conversion. You must know how to convert from number of shares into value. You must also know how to convert from value into number of shares. Let me show you. You may not know the importance of this yet, but later you would know. Okay, just know how to do it first. How to know how to do the conversion. On the left column, you see given 400,000. This is in value, right? This number is in value. Ordinary shares or 40 cents each. 40 cents each means every share is worth 40 cents. So how can you get the value to number? Easy. Total number of shares issued, you take $400,000 divided by 40 cents. Okay, if your math is good, I think this is something very, very easy. 400,000 divided by 0.4, meaning this $400,000 is equivalent to 1 million number of shares. Okay, must know how to do this conversion. The other column on the right is the other way around. Given 500,000, this is number of share because you don't see the dollar in front. There's no dollar in front. So this is number of share. So 500,000 number of shares, 50 cents each, convert all of them into value. So take 500,000 number of share times 50 cents, you will get $250,000. Right? Okay, so this is about the conversion between number of shares and value of shares. You must know how to do this. And where would you apply this? I will show you in the future, okay, or later. For now, just know how to do this. So one is division, one is multiplication, right? Can see the difference? Okay, to convert from value to number, divide. To convert from value to convert from number to value, you multiply, right? Okay, so that's the difference. Next page. Okay, here is super important. Here is something super important. Debentures. Okay, the word debentures. Page 302, upper half of the page, debentures. Let me make you recall where you saw this term before. For those of you who have learned the first few topics with me, okay, all the earlier topics that you have learned is in chapter 1. You saw it in chapter 1 with me. For those who did chapter 1 with me. Debenture is here. It's a non-current liability that is only available to the company. Okay, you just have to see this as a borrowing. Okay, company borrows money. Why don't you call it a loan? I also do not know. Debenture is something that you would learn if you study a course known as finance. You would know debentures in details, but I don't even know, okay, the full details of debenture. But for this subject purposes, for accounting purposes, we only have to know that debenture is a non-current liability and we see it as a loan. We see it as a loan, okay? And it's only available to the company. Only company can take this kind of loan. Only companies can take this kind of loan known as debenture and is NCL. Let's come back to here. So first line, you write a non-current liability. Okay, right here, non-current liability. Only for companies. Why? I also do not know. Okay, why is it only for companies? I also do not know, but this is something that this is the only thing you have to know. It's only available to the companies. But for an accountant, the full details of debentures, we don't have to know. Okay, just see this as a loan. Next, who is the lender? Lender is somebody who gives money to the company. Who are the lenders? Lenders are known as debenture holders. Yeah, this term you have to know. This term you have to remember. Debenture holders. And these two terms, you can remove it. These few words, you can remove it. Lenders are known as debenture holders, the people who give money to the company. Okay. Who is the borrower? Borrower is the company, also known as the issuer of debenture. Yeah, here is a new term, issuer of debenture. Okay, issuer of debenture. In fact, on the right-hand side, you see a picture here. That's an example of debenture that I found online. Okay, it's a piece of paper. It's a piece of paper. And on this piece of paper, what would be written on the paper is who is the lender, who is the borrower, and how much has been borrowed, and when would be paid back in the future. And then there will be signature here and there, indicating that there's a debt that exists. Okay, this paper tells you that there's a debt that exists, who owes whom money, and when this would be paid back. Okay, it's like an evidence of the debt that exists. Okay, evidence of existence of the debt. But don't worry, they will not ask you to draw this debenture diagram. Okay, don't worry, just to show you in real life what it looks like, how it looks like. Lenders, debenture holders, borrower, company, also known as issuer of debenture. B, when there is a loan, there must be an interest, right? Since this is a liability, there must be interest to pay. So company being the borrower must pay fixed rate of interest. Okay, write down interest. When there's a loan, there must be an interest, right? There's no free loan in this world unless it's between your friends. Today, I lend you 3 ringgit. Tomorrow, you give me back 3 ringgit without interest. Okay. Okay. So at a future date, the company would buy back the certificates from the group of lenders. This line, remove it. I don't want to confuse you further. Okay. This line, you can remove it. Not important for this subject. So for now, what you have known so far for this thing? Debenture is a non-current liability only available to the companies. Lenders are the debenture holders. Borrower is the company. And interest must be paid. Must be paid. Okay. So let's have a look at the table at the bottom here. When you are describing a debenture, you must have a few components in its name. You see, here's an example. 10% debentures 2024. There must be a percentage attached to the name of debenture. And this percentage refers to the interest to pay, the interest rate to pay. Okay, that means every year the company has to pay 10% interest. Okay, and the year that is attached to the name of debenture is the future year. Okay, you can write the word future here. The future year in which the company has to repay the loan. Okay, that means, so right now it's 2022. 2 years later, the company has to pay back this debenture. Okay, so that's the standard name of a debenture. You must have both the percentage and the year attached to it. When you copy it into your SOFP, remember SOFP, where you have assets on top, then capital, then liabilities. When you copy this into the SOFP as a non-current liability, you must also copy the entire thing. Don't just write debenture, it would be wrong. You must write the percentage, debenture, then write the year. Okay, I show you one example. You stay on this page, okay? I show you one example. You look at my screen. hold on. Here. But this is slightly not complete. Okay, 4% debentures is lack of the year. Here is lack of the year. I show you another one which is more complete. Here is a complete debenture naming. 3% debentures repayable 2020. Okay, so this is a standard naming of a debenture. It must come with the percentage and the future year. So you see why is it 2020? Because this question came out in 2016. Okay, so 2020 in this question is 4 years later. I show you. Okay, so get back to the notes. Okay, get back to the notes. Let's learn more about debenture. So I told you that debenture is a non-current liability, right? And debenture holders are the creditors. Okay, and the company owes the debenture holders money. Okay, that's why you can call the debenture holders as creditors. Remember about the priority? The priority in getting back the money when the company closes down? Creditors would get back their money first. And this includes debenture holder. Okay, this includes debenture holder. So debenture holders would get back their money first, before preference shareholder and ordinary shareholder when it comes to the company closing down. Okay, when the company closes down, creditors will get back their money first. So you would mention that debenture holder term when you are describing this this story. Okay, later I will show you how to write in the question. Okay, so see this table again. Let's see this table again. We look at the advantage. There will be no dilution of ownership for the existing shareholder, because when the company takes a debenture to borrow money, there won't be more shareholders around. Okay, because debenture holders are not owners of company. They are not owners of company. Only shareholders are the owners of company. Okay, therefore, if the company wants to raise money by issuing debenture, then there's one advantage. There won't be more owners. There won't be more owners around of the company. Therefore, no dilution of ownership. Earlier we talked about this term, right? Dilution of ownership is about the lowering of power to the existing shareholder. But if the company issue debenture to raise money, there would not be dilution of ownership to the existing shareholder. Yeah, so must really understand the term dilution of ownership. Otherwise, you may have confusion. Okay, when I'm explaining here. Look at the disadvantages. Remember earlier we talked about the priority in getting the dividends. Preference shareholders would get dividends first before ordinary shareholders get their dividends. Now, let's have one more group of people known as debenture holders. What do they receive? They receive interest. Because they are the lenders. They are the creditors. Companies pay interest to the debenture holders. So now you have three groups of people here. Debenture holders who want to receive their interest, ordinary shareholders who would want to receive their variable dividend, preference shareholders who would want to receive their fixed dividend. Okay. Who would get what they want first? Among the three groups of people, debenture holders first. So right now, the priority, debenture holders would receive their interest first, then followed by preference shareholders receiving their dividends, then followed by ordinary shareholders receiving their variable dividends. Yes, this is confusing. Who set this as the rule? I also don't know. Okay, this is something set by the rule and regulation. We just have to study, apply, come out with the income statement later. Okay, let me repeat. Here you have three groups of people. Debenture holders want to receive interest shareholders want to receive dividends, and here is the sequence of priority. The sequence of priority. 1, 2, 3. Now let's talk about the next point. Company's closure. Company's closure. When the company closes down, what would happen? It's the same thing. Debenture holders would get back their money first because they are the creditors. They are the non-current liabilities. Before, ordinary shareholders and preference shareholders receiving back their invested money. So it's the same thing. You write debenture holders would get back their money first, then followed by preference shareholders, then followed by ordinary shareholders. Okay, now, next point. So far throughout this topic, we have not seen any numbers, right? Okay, we have seen very, very few numbers throughout the first few pages. Don't worry. Next lesson, we will be seeing a lot of numbers. Okay, few more pages. Okay, few more pages back, we can see a lot of numbers behind. Here, okay, this table has a lot of numbers, but that's the nature of the topic. Okay, this topic has a lot of theory. Okay, last point, second last point. Interest must be paid by the company regardless of its business performance. Don't you think so? When you have borrowed money, you must pay interest, right? You must pay interest. You cannot tell that this year's business is not good, so I don't want to pay interest. Can you do so? No. In real life, when you have borrowed money to buy a car, can you say that you don't want to pay for the installment when there's COVID? No, right? Okay. So you must pay interest. Okay, you must pay interest. Must be paid. But compare this to ordinary shares. Compare this to ordinary shares. When the company is not doing well, the company can pay 0 dividends to the ordinary shareholders, right? That's the benefit. Okay. When the business is not doing well in a year, the company can choose to pay 0% dividend to the ordinary shareholders. But for a loan, you must pay interest regardless of how good the company has been doing. So more about this when you see the questions. Next, debenture holders have no voting rights in any company's meeting. Of course, because they are not owners. Even preference shareholders don't get to vote. Only ordinary shareholders get to vote. Okay, so with this table, let me tell you what is really important about debentures in the exam, in the theory question. Examiners favorite, okay, write down. Examiners favorite. They always want you to compare 3 groups of things. They like to make you compare ordinary share against preference share and also against debentures. Later, I show you more questions. Earlier, you did a lot of questions on this comparison, right? Ordinary shares vs preference share. And this time, there's one more item, debentures, and they always ask you to compare these 3 things. Okay, compare these 3 things among one another, against one another. Okay, let's see some questions. Let's see some questions together. On the same page, help me to remove this. I don't need this anymore. Remove this. These few paragraphs, I don't need to use them anymore. Let's go to some questions. Hold on, yeah, finding the question. Here, page number 327. Page number 327. Okay, page number 327. We are now looking at question C2. Okay, page 327, question C2. Okay, as I said, they like to ask you to compare these 3 things. ordinary shares, preference shares, and debentures against one another. So have a look. Let's do together. Two similarities between preference shares and debentures. What are the things that are the same between these two things? Both of them have no voting rights. Okay, so let's write together. So both finish. Okay, then next line you write. Oh, this is page number 327. Okay, 327. Okay, those who don't get what page this is 327. 327. Okay, next line. Agree, right? Okay, preference shareholders don't have voting rights. Debenture holders, they don't have voting rights as well. Next, we talk about their interest and dividend. Don't get confused between interest and dividend, okay? Dividends are received by shareholders. Interests are received by creditors, okay, like debenture holders. So you write, we talk about the fixed element being the same. So you write dividends okay, no voting rights. Dividends received by preference shareholders and interest received by debenture holders are both fixed. I know one is dividend, another is interest, but I'm not referring to dividends and interest. Okay, I'm referring to the fixed element. Okay, the fixed element as the similarity. Okay, so once again, done with writing. You tell me with the word done. Then we see the next thing. We see the next question. Okay, I wait for two more responses. Then we see the next question. Okay, I wait for Celine. Okay, good. Now see the next question together. So this question came out in 2018, October, November, not long ago. Okay, really not long ago. We see the next question. Here, page number 332. Okay, page number 332. 332. We see question C together. 332 question C. Okay, let's read this together. This time is between debentures and ordinary shareholders. Okay, existing ordinary shareholders. They say suggest two disadvantages to the existing ordinary shareholders if the funds are raised by issuing debentures. Disadvantages. Okay, so how is this linked to ordinary shareholders? We can talk about their priority. Their priority when it comes to closing down, another priority when it comes to distribution of interest and dividend. debenture holders always get prioritized first. So let's write together, okay? Before we write, you see the first two paragraphs that are related. Directors are the people who run company. Directors are like workers. Directors are hired by shareholders. Directors want to raise $100,000. Raise means get money, okay? In order to expand the business. See, they need the money to do some expansion. After the first 2 years, should increase the annual profit before interest by 25,000. This is something that is like a forecast, okay? Forecast. They forecast that in the next 2 years, they will get some profit for the year. Propose to raise the funds, suggesting, okay, doing some suggestion by either issuing more debenture or more ordinary shares. So they are trying to decide whether they should sell more ordinary shares or to get a debenture, okay, borrow money. So what to write? Let's write together. Disadvantages, you write. Okay, next point about the priority also, but in the environment of closing down, companies closing down. Liquidates means liquidation, okay, closing down. When company liquidates, would likely receive, okay, likely receive no to little return of their invested capital. Okay. I know it's very lengthy, it's very long, the answer, but I don't see any way of rephrasing it to retain the meaning while I write fewer words. Okay, yeah, I have to have all the words here to make it make sense. Okay, so don't just write, yeah. Once you have written, you also read, ensure that you understand. Then we move on to the next question. Okay, again, the word done. Okay, I wait for you. Okay, good. Chen Chin and Celine are done. Liquidity. Liquidity is different from the word liquidates. Liquidity, we will talk about it in the next chapter, chapter 16. But the word liquidates here means company closing down. Okay, liquidates means company closing down. Okay, now we see the next thing. Okay, 1, 2, 3, 4, 5, 6. Okay, good. Now we see the next thing. You see, it's not just important for this subject alone, okay? In the future, if you happen to be doing your own business, you have to know all these concepts, okay? Because when you run any business, let's say you study medicine, you want to open a clinic, you must know all these concepts as well, okay? You must know all these concepts as well. Even if you can hire accountant, you must still know some basic accounting knowledge. Therefore, here is the chance for you. If you want to study engineering, in the future, you open one engineering, something related to engineering, okay? You must still know accounting, okay? Really. Okay, Zami, no worries. Zami, you take a picture of this. You went to the washroom just now. Yeah, you use your phone, take a picture of this, then later you copy. Okay, finish, yeah, okay. Okay, so this is page 332. Later you copy onto this page. Okay, page 332, question C. Okay, next page, question A. Okay, next page, question 6, CD Limited, question A. See, two differences between debentures and ordinary shares. Okay, that I mentioned, there are many questions that are linked to those three things: ordinary share against preference share against debentures. We cannot escape. This is a question coming out in 2018 actual exam in May, June. Let's see the A. So what are the two differences? You can talk about voting rights. Voting rights. So let's write together. You write debenture holders Okay, so how can you get the 2 marks? Here 1 mark, here 1 mark, okay? And then you tell another difference, then 2 marks more, then you can get the full 4 marks. Next, we can talk about the fixed and variable component. Okay, the thing about being fixed and variable. You write debenture holders variable dividends. Okay, don't get confused between dividends and interest. Dividends are received by shareholders, interest are received by debenture holders. Is this a relevant question? Of course, okay. All the questions you have been doing, they are very relevant. They are past exam questions. Okay, again, I wait for the word done from you. Then we see the next question again. Okay, good. Now let's continue. Here, page number 334, page number 334. Again, question E and F. State 1, advantage to ordinary shareholders. If the CD Limited, when you see limited, it means company. CD is the name of the business. Raises the money by issuing debentures. So earlier we saw one similar question, but at that time it asked for disadvantages. But here it's asking for advantage to the ordinary shareholders if the company raise money by issuing debenture. Advantage to them is dilution of ownership. Okay, sorry, no dilution of ownership, you're right. There would be no dilution of ownership because debenture holders are not owners. Okay, debenture holders are not owners. Therefore, the power level of the shareholders would not get reduced. No dilution of ownership to the ordinary shareholders. Okay, next, you have question F asking for a disadvantage, which is the other way around. To them, if company issue debenture. So you can talk about the priority again. Let's write again. Okay, let's write the answers again. You're right. Okay, when you're done, let me know with the word done again. Then we see the next question again. Okay, good. Celine, Minjun, and Wayven, you are done. Okay, wait for Ming. Okay, good. Next question. Okay, it's always tiring when I do this topic because there are really many things to go through and also questions to answer, many questions to answer. Okay, continue to see. Okay, page number 338, page number 338. But I can guarantee you that if you can finish all the questions in this handout, if you can finish all the questions in this handout, then you would have mastered this topic. Okay, really, the same goes to all the earlier topics. If you can finish all the questions and you have understood why you make mistakes for any mistakes you have made, then you would have mastered those topics. Okay, because for every topic in my materials, the questions are very complete. The varieties of questions are very complete. If you can finish everything and you can understand everything, then you are good. Okay, you are good to go. You can prepare for the exam. You're well prepared. Okay, here state two features of debentures. Features mean characteristics, right? Okay, wants to expand and requires $300,000. Convert into Malaysian ringgit, it is about 1.2 million ringgit. Considering raising the funds from either issuing 3% debenture or issuing 4% preference shares. Don't worry, the exam will not ask you to decide. The exam would not ask you to decide which one to go for. Okay, in the future, if you do a business related course, you would be asked to decide. Okay, you would be asked to decide, and you have to present them. You have to present to them with some arguments why you choose debenture, the pros and cons, why you choose preference shares, what are the pros and cons. Okay, but not for IGCSE. They won't ask you to decide. State two features of debentures. We can talk about fixed interest and no voting rights. Let's write together. Debenture holders have no voting rights. Don't have to explain. Don't explain. You're right. Next point. Debenture holders finish. Okay, so don't have to type the word done. I give you 20 seconds. You write. Then when the time is up, we move on to the next question. Okay, just a few words, right? Okay, 20 seconds starts now. Okay, time's up. Should have done, yeah. Okay, just a few words. Let's see the next question. We see, okay, cannot do this first, okay, because I have not taught you the term equity, okay. I thought you could do this initially, okay, but when I went through the entire thing, you have not learned the equity in details yet, so cannot do this first. Then oh yeah, I'm looking through. This is good. Come to page 343. Some questions for you to answer. The answer that you have to give to me is very easy. It's either true or false. Okay, but don't think that it's easy. You have to really understand what I have mentioned earlier, then you can answer correctly. So let's read this together and then I ask you a few questions. Completed. This is page number 343. Okay, 343. 343. Complete the table by placing a tick in the correct column to indicate whether each statement or sentence is true or false. First one has been done as example. Let's read. Reward given to ordinary shareholders for investing in the company is known as dividend. Agree? Okay. So true. Okay. Now, this is for you to answer. So let's read this question. Read the statement together. Then I'll let you answer true or false. Amount of issued shares for which payment has been received by the company from shareholders is known as paid up share capital. Everyone, you can start to answer. True or false? It's regarding the four terms that you learned earlier. Give everybody 20 seconds, then you tell me true or false. Right or wrong doesn't matter, but this is quite straightforward, okay? Better to get it right. Okay. Most of you have not answered. I give you more time. Maybe you need more time to look at the notes. Okay, more than enough time, yeah. Okay, 30 something seconds. Okay, I've received 2 answers. Send the answer to me, yeah. Okay, don't send to everybody. Okay, let me receive one more answer. Then I can tell you right or wrong. Okay, Emilia, what is your choice? A. You have to focus on the term paid up share capital. Remember, I asked you to know the definition, right? So let's see the definition. Definition for this term, it is here. So what is paid up share capital? So I think as the term implies paid up, paid means past tense, right? So it must have been paid. So you read this, it says the portion of shares payments have been requested for which have been fully paid. Okay, paid already. Shares that have been paid, do you think that they have been issued? Do you think that they have been given to the investor? Of course. Okay, because issuing or giving shares is the second step. Okay, therefore answer is true for that question. So you write here, put a tick there, true. Okay, because amount of issue shares for which payment has been received, okay, by the company from shareholder. Okay, next, read this yourself, then you tell me true or false. I read for you, okay? Ordinary shareholders receive a fixed percentage of profit each year. They should replace this word with dividend. Okay, you replace it with dividend. They have a typo here. I set the timer. Also 30 seconds. Okay, I wait for Chen Chin's answer. Okay, 1, 2, 3, 4, 5, 6. Okay, everybody has answered. Answer is for sure false. Remember, ordinary shareholders, they receive variable rate of dividend. It is preference shareholder receive fixed dividend. Okay, straightforward. Yeah, so answer is false. Okay, answer is false. It is something that I talk about in the table. Okay, the table that compares ordinary shares and preference shares, right? Ordinary shareholders, they should receive variable rate of dividend. Okay, it's not fixed every year. Okay, next, you read this, then you answer true or false. In the event the company being wound out means wind up, means closing down. Okay, ordinary shares are the last to be repaid. True or false? Okay, I wait for everyone. It's about the priority. Remember? Okay, I wait for you. Set the timer. Okay, wait for one more answer. Okay, good. Everyone has answered. Answer is true. Answer is true. Why? Because when the company closes down, ordinary shareholders are the last group of people in getting back their money. So I show you where you learn this. It is the diagram I asked you to draw just now. When the company closes down, what happens? All the assets would be sold off, then turn off them into money. Creditors would get back their money first, then followed by preference shareholders. Lastly, ordinary shareholders get back their investment. Okay, so true. Okay, next sentence. Next sentence. Ordinary shareholders are personally liable for the debts of the company. Okay, true or false? Tell me in the chat box. Okay, timer again. Okay, once we are done, we dismiss. Yeah. Okay, I wait for 2 more answers. Okay, good. Everybody has given the same answer, which is correct. Sorry, your answers are correct that it is false. Okay. This is linked to the advantage of limited liabilities that I explained to you in the last 2 lessons. Remember, ordinary shares, if they have paid 1,000 to buy shares, that's their maximum loss. They cannot do more. They cannot use their personal things to pay for the debts of the company. Don't have to. Okay, so this sentence is false. Okay, last one, I think you cannot answer yet because I have not taught you what is statement of changes in equity. Okay, but based on your responses, I think you have understood a lot of what I have mentioned. Okay, good. And one more second, yeah, I see if there's any more thing that we can do before we go learn more. Okay, I think we continue next week on page 345. Okay, next week we continue with page 345. Then we go back to the notes again. Hope we can finish off this topic next week. Then we move on to the chapter 16. Then there are not many things left. Okay, have a nice day, everyone. See you next week. Bye. Everybody, welcome. Have a nice day.